Hello and welcome to Quartergieviat's Markets Uncut podcast, your weekly insight into the topics and issues that we've been discussing here at Quartergieviat. I'm Jack Bishop, investment manager based out of our Manchester office. And this week I'm delighted to be joined by our regular commentator and head of fixed interest research, Richard Carter, alongside Ben Barringer, one of our equity research analysts covering the technology sector. Good morning to you both. So a busy week all round last week. Campaigning continued in the UK ahead of July's general election, with both Keir Starmer and Rishi Sunak zigzagging across the country, both trying to outdo one another to control the narrative. And over in the US, we had former president and likely Republican nominee Donald Trump found guilty on all 34 charges associated with his hush money trial, although being a first-time offender, it's unlikely to lead to any jail time, and with his legal team's efforts to delay his other court cases, his focus will again turn to November's election. So bringing the focus back to markets, there was a lot of economic data to digest throughout the week, including a raft of inflation readings and revision to the US's quarterly GDP figure. So all of that led to quite a volatile week for bonds all round. So at the start of the week, there was another weak treasury auction for 7-year notes. We then had, as I mentioned previously, the revision to the first quarter GDP estimate down from 1.6 to 1.3, indicating the economy is growing at a slower rate than we initially thought. And that downward revision to consumer spending seemed to be the main driver. Richard, is that perhaps conversely a positive thing for inflation if consumer spending is slowing slightly? And what do you make of the weaker treasury auctions given the growing deficit in the US?
Yeah, I think with the consumer spending slowdown, I think sometimes bad news can be good news as far as markets are concerned, because it means, like you say, if US consumer slowing down a bit, inflation pressure should ease, and that could mean more potential for rate cuts from the Fed. Yeah, so I think markets took that reasonably well, although obviously if it slows down too much, that would give rise to different concerns. I think these treasury auctions, they're issuing huge amounts of bonds in the States because of the large deficit, same as we are here. You do get the occasional auction, which is a bit disappointing, but I wouldn't overstate it at the moment in terms of its impact. There are clearly concerns if Trump does win the election, despite his legal troubles, that if he goes and starts cutting taxes, that could push the deficit out even more. So there are some concerns there, but I think for now, the odd week treasury auction we shouldn't get too concerned about. And I think if inflation weakens, consumer weakens a bit, and the Fed's able to start cutting rates, that should probably be the bigger story as far as bond markets are concerned.
Yeah, just turning to inflation, we did just allude to it. So the Fed's preferred measure of inflation came in on Friday bang in line with expectations. So core PCE, I think, was 2.8% year over year, and then the broader measure was also in line. And then in the Eurozone, inflation came in at 2.6%. So that was just a little bit higher than expectations, a re-acceleration from the 2.4% recording back in April. And then we also had unemployment, which came in at 6.4%. So that's the lowest, I think, since the creation of the single currency. So good news on employment, but perhaps not so much on the inflation side of things, as some of the there are some one-off impacts, I think, into the inflation readings. So do you think that would derail this week's ECB decision for a rate cut?
Well, derail is a good phrase to use, perhaps deliberately, because some of the impact, inflation readings in Europe, partly due to base effects on German rail ticket prices. They were heavily discounted last year and now sort of back to normal. So there were a few one-offs in the inflation numbers, but overall, a bit like here, a bit like US, service sector still pretty strong, wage growth pretty strong. So it wasn't all due to kind of one-offs. I mean, it's not going to derail this week's ECB rate cut by the looks of it. It seems that 25 basis point cut on Thursday. That's pretty much a done deal. But going beyond that, how much is the ECB going to be able to cut interest rates this year if inflation remains sticky? Probably not by much. I think there's about two cuts of 25 basis points priced in for this year only, and a bit, as I say, a bit like UK and US. If inflation remains sticky, rates can only come down very, very gradually. But I still think we'll get a cut this week.
Okay, yeah, guess we'll wait and see. And then just more generally on bonds, could you just give us a recap? Where does that all leave us year to date in terms of performance, yields, and maybe your expectations for the asset class for the rest of the year?
Yeah, it's not been a great year, to be honest. Slightly mixed, but the sort of, back at the start of the year, everyone was expecting rate cuts by now, really. And quite a few as far as the Fed and the Bank of England were concerned. And those haven't materialised because inflation's not justified it. It's too sticky, and labour markets are strong as well. So here we are going into June, and yeah, we're going to get a rate cut from the ECB, but a rate cut in the UK and US still looks some way off. So that's not been good for bonds. Generally, I think UK gilts are down about 4% year to date. UK investment grade corporate bonds have done a bit better because economy's holding up well, although they're still down about 1%. So yeah, yields are up. But May actually wasn't a bad month for bonds in the end. I still think where yields are at the moment, over 4% on gilts in the UK, sort of 5.5 in credit, relative to where inflation is now. Don't forget, inflation coming down, that looks pretty attractive. So I think expectation for the rest of the year is that the return should improve. But we do need to see those rate cuts come through, not just from the ECB, but also the Fed and the Bank of England.
That's really helpful. Thanks, Richard, to give some context where we are. So thank you for that. Turning to you now, Ben. Firstly, thanks for joining us. The first thing I wanted to discuss with you is NVIDIA, which seems to be carrying the whole market at the moment. So firstly, I think for listeners that maybe aren't familiar with the company, could you just give us a brief introduction to what they do? People will clearly be familiar with the likes of Microsoft, Apple, Amazon, but maybe not with NVIDIA, who's grown in market cap since. And then give us a sense of how the company has evolved maybe over the last 5, 10, 15 years to become arguably the most important company in the world, it seems.
It's certainly getting close, isn't it, Jack? It's now at $2.6 billion in market cap, which is knocking on the door of the $3 billion that both Apple and Microsoft sit at. So yes, so NVIDIA, for the uninitiated, is a company that designs and sells graphics processing units, or GPUs. And so historically, it's been a big player in the video game market. So if you had a PC, you probably had a graphics card in there, particularly if you wanted to play games. That graphics processing unit was very good at calculations in sort of parallel computing. And so all the way back in 2012, somebody, actually a Russian Canadian data scientist, discovered that GPUs were actually very good for artificial intelligence, actually in a image identification competition amongst AI scientists. And that was the real first leap and insight into the fact that GPUs were very good at AI, particularly for training models. So yeah, over the last 10 years, that business has grown within NVIDIA. Remember that NVIDIA, as I say, was big in the graphics market. Also, GPUs were very good for Bitcoin mining and cryptocurrency mining. And so that's been a tailwind for the business. That's now sort of fallen away. But the AI business, mainly providing chips that go into data centers to do AI training, that has gone from being about 10-20% of the business 3 years ago to almost 90% of the business. And so that's been the real driver there. Just one quick technical point. NVIDIA designs and sells the chips, but actually they're made by TSMC, and also some of the chips are made by Samsung as well. So they're what's called a fabless company. They don't actually make the chips, but that's like quite a lot of other companies, AMD, for example. So yeah, so that's the basic where we are with NVIDIA. As I say, everybody is watching that for the growth in data centers, not only the growth in cloud, but also the increasing mix of AI enabled processors within the data center.
That's brilliant, just to give a bit of context to how they've come to be the company they are. And they do seem to have somewhat of a monopoly on AI chips, and particularly with their CUDA software. So maybe just a quick word on their CUDA software and why they've got that position, but also who do you think in terms of companies could challenge their supremacy?
Yeah, so their current sort of, if you look at accelerators, which are generally the sort of group of chips that do AI, their market share is around 85%, we estimate. And it's not just chips, as you say. They also have technology for networking. It was an acquisition they did called Mellanox to provide a networking infrastructure for their chips, because it's very important that all these chips talk to each other. So that's another part of their moat. And then, as you say, the CUDA operating system basically is the main way that AI scientists program for AI chips. And that's a relatively hard ecosystem to break. We've only really got two, got the Windows operating system and we've got the iOS operating system. Similarly, in smartphones, we've got the iOS operating system and Android as well. And so there is room for another operating system other than CUDA. Probably the most likely is an open source technology called Rockham. We watch that very, very closely. But that, at the moment, there isn't a really clear alternative to the CUDA operating system. In terms of other competitors, AMD is a supporter. AMD also has GPU, graphics processing unit, intellectual property, and is trying to challenge in that area. The other area that is quite prevalent is ARM based. So rather than using the traditional GPU technology, you use the same technology that's used in your smartphone. So ARM, the Cambridge based company. And there's lots of companies that have been pursuing that kind of strategy. So Amazon Web Services has its own silicon that you can buy and use in their cloud. That was part of an original acquisition they did back in 2015. The chips are called Trainium and Inferentia, so for training and inference. Google also has a chip called a TPU. So that's a tensor processing unit. So that's, again, for using in AI. And then finally, and most recently, Microsoft has been reasonably slow in doing its own silicon. They've got two chips called Maya and Cobalt. Now, just because you've got chips, and then I should say there are some other startups. There's companies like Cerebras and GraphCore. GraphCore is actually based in Bristol. There are other chips that people can use, but the issue is making it easy for AI scientists and creating an ecosystem. So just because you have a chip doesn't mean you can necessarily take market share. We think that AMD will gradually chip into NVIDIA's very strong market share, as will that own silicon. But at the moment, it's pretty much an NVIDIA dominated race. And I think one of the things that's very important is that their product cadence, i.e. the rate at which they release new products, is actually shortening. So it's gone from about 18 months down to about a year. And they were actually talking last night at Computex about their roadmap out to 2026, 2027, as was AMD as well. But it really gives not only investors, but mainly their customers that roadmap, so that they know that they can sort of standardize on either NVIDIA or AMD's roadmap. Roadmaps are incredibly important in tech.
And then if we zoom out to maybe tech performance year to date, obviously NVIDIA has been performing phenomenally well, but you've seen that divergence between companies that are more associated with the components and the hardware versus the more software orientated companies. So maybe just give us some context and your thoughts as to why you think that might have been the case.
Yeah, that's exactly right, Jack. So if you look at the NASDAQ, it's up 12% year to date. But within that, semiconductors is up 22%, mainly driven by NVIDIA, which is up 121%. But also software has actually underperformed not only the S&P, but it's also it's gone down year to date. So it's the IGV, which is the software index, it's gone down about 3%. Now, you've got to remember that both these groups had very strong 2023s. And so there was a lot of expectation that AI was going to be the driver for both semiconductors and for software. And you see this in quite a lot of cycles. You certainly saw this in the sort of internet boom as well, was that, the companies that are providing the picks and shovels, I don't particularly like that term, but the picks and shovels for the next generation are the ones that benefit first, and then you see the emergence, once that infrastructure is established, the emergence of sort of second and third third tier beneficiaries. And so what we expect is that semiconductors will continue to do well through most of this year. And then as we get into 2025, then some of those software companies, Microsoft is a very good example, Intuit could be another one, Salesforce potentially as well, where they start to use the AI to improve their software, make it more intuitive, and that improvement in their software classically leads to better pricing, and so that helps sales as well. So yeah, I mean, look, Nvidia's last set of results were very, very strong, and we still think that the demand is outstripping supply, and there are very good reasons why not just cloud providers but also other enterprises. Look at JP Morgan's recent results with their step up in terms of their tech spending, but also governments as well spending on AI. So Nvidia looks reasonably underpinned at the moment, but we are very, very focused on looking for any signs of weakness. Things like the Asian supply chain, components that also go into these chips, like high bandwidth memory, advanced packaging, a thing called CoWoS. So we're very attenuated to the fact that these things can turn into bubbles. But at the moment, Nvidia does look pretty well placed.
And then just one last question whilst we've got you, Ben, finally on UK tech. So one of our preferred tech names that we held, Darktrace, is likely to be taken over. So what are your thoughts maybe on tech listings in the UK? What do we get right? What do we get wrong? And then what do you think the UK could do to make themselves a more attractive destination for these companies?
That's right. So Darktrace, which was acquired or is in the process of being acquired by Thoma Bravo, is the latest in a long line of UK tech companies that have been acquired. In the last decade, we've had Arm acquired by SoftBank and then refloated on the NASDAQ. We've had Sophos acquired by Thoma Bravo. We've had Aviva acquired by Schneider Electric. And then again, we've had Darktrace acquired by Thoma Bravo. And so, this is a long line. And every time we've had big positions in these companies. And so, clients have benefited. But it's bittersweet because it means we have to try and find another high quality company in UK tech. And that is getting increasingly difficult. When you think about the sort of systematic reasons why companies prefer the NASDAQ to the UK, you've really got to think about UK tech entrepreneurs and the reasons why they would want to be listing on the NASDAQ rather than on the UK. And I think there's a number of sort of fingers to point, if you will. First of all, I don't think the venture capital industry in the UK is as strong as it is in the US. Second of all, I think some of the listing requirements and the focus of the London Stock Exchange hasn't been as focused as it should be on promoting new companies to list there. I think there are also some government regulations, and I think that didn't help the re-IPO of Arm in London. And then finally, and if we have to point fingers at ourselves or certainly at UK investors, I think UK investors are much more focused on profits and dividends rather than being focused on growth. When I spoke to the Darktrace CEO about why she decided to sell to private equity, people just didn't believe in her vision. They weren't prepared to back the growth. And so I think we have to take a long, hard look at ourselves about how we think about investing. Is it just about providing dividends, or is it about trying to support next generation of companies that are coming up and through the London Stock Exchange? So yeah, like I say, it's very bittersweet, I'm afraid, Jack, because great that the business got taken over and we did very well for clients, but on the other hand, a shame for the UK. The final one, I think, is it doesn't get much headlines, but back in 2014, DeepMind was actually acquired by Google. It was a private company out of one of the London universities, but that's now the absolute core of Google's AI strategy. And so, it's not just about public markets, it's also about private markets as well. So, final thing to say, I'm talking on the 13th of June. I'm just back from an Asia trip. So if you want to hear a little bit more about my Asia trip on the 13th, there's a webinar. So ask your investment manager for those details.
Perfect, Ben. Thank you very much. I'm sure that will be interesting as well. So thank you, and to you, Richard, for your insights. We're very proud to announce that we've been shortlisted for the best podcast at the Investment Marketing and Innovation Awards for both the Taking Stock and this weekly comment podcast. So thank you to all of our listeners for your continued support. Before we draw to a close, if any of our listeners have any questions they'd like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. And then to stay up to date with our thoughts on markets and current issues, please visit our website at www.quiltscheviot.com. Here you can see more of what we're doing at Quilter Cheviot, as well as any past webinars on demand, and you can subscribe to our weekly comment newsletter. So we'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. So thanks again to Richard and Ben for their time today, and to all of you for listening.